Oh man, all right, guys. I've been trying to rush home so I could cover this. I was at jujitsu for a little bit. Got kneed in the temple. I can't even look at it. It's kind of swollen. Oh my gosh, dude, this is gonna be a freaking shiner, bro. Ugh, dude, I'll try to make the screen bigger. Tell me how bad this is gonna be. I can feel it. It's swollen. I didn't even realize it. I guess my adrenaline was running. But today we got the FOMC Minutes report going live in about 45 minutes, a little bit over that. Let me make sure everything's going cool and smooth and running well. Whew, man. I literally rushed home. We're live. Let me make sure everything good. I literally rushed home. Yeah, we're good. Whew, all right. Fed Minutes report today. It's like a detailed reaction. Nvidia, Apple, slightly green on the day. Let's look at the Q. Q's pushing up, getting ready to approach all-time highs ahead of the FOMC Minutes report. Slightly green on the day, still red a little bit. Still, honestly, the NASDAQ still technically red over the last day. Let's do a poll. Are you bullish or bearish on today's FOMC Minutes report? Vote on this poll. Let's get some music going so it's not so dull here. Let's take a look at this black eye that I just got. I'm pretty sure I just got a black eye. I can feel it. It's right here. Oh my gosh, dude. It's like right on my eye socket. All right. All right, look at this thing. Right here. Ooh, it's swollen. Look, can y'all see that? Look at this. Whew. I just got back from jiu-jitsu, but man, this is like swollen right here. It hurts right here. Oh my gosh, dude. This is going to be like, I can see it. Look at right here. Oh man. Dude, this is going to be like my 10th black eye this year. Genuinely my 10th black eye this year. Damn, man. Another one, bro. My wife is like... I look like I'm a freaking Street Fighter. I don't know how it happened either. Somewhere in a scramble, I got a black eye. Oh, dude, I literally like sped home. I needed to shower after jiu-jitsu, but man, dude, black eye number 10 this year. I gave you that eye. Why are you lying? Yeah. Debo did it, okay? Bullish. 58% are bullish on the FOMC Minutes report. Let's get ready. Today, all eyes turn on the Federal Reserve as it releases its eagerly anticipated FOMC Minutes meeting minutes set to drop at 2 p.m. Eastern. These minutes promise to offer critical insight into the central bank's thinking on inflation, interest rates, and overall economic outlook. With markets hanging on every word, traders and analysts alike are poised for clues on the Fed's next move. The January meeting brought mixed signals, with the Fed acknowledging persistent inflationary pressure while hinting at possible policy adjustments later this year, meeting rate cuts. Today's minutes will reveal what went behind closed doors. Were policymakers more divided than they appeared? How concerned are they about inflation running hotter than expected? And perhaps most importantly, what conditions might trigger a sooner than expected rate cut or a shift in their tightening stance? For investors, it's a much-watched material. The FOMC Minutes report have a history of moving markets, often sparking significant shifts in Treasury yields. Specifically, the dollar's strength and equity performance, a dovish tone could fuel a rally in stock and bond prices, while a more hawkish readout might reinforce the recent upward drift in bond yields, like the 10-year yield spiking up recently. Beyond the market impacts, these minutes serve as a guidepost for businesses and consumers alike. They shed light on the Fed's assessment of labor market conditions, consumer spending trends, and global economic risks. In a time of heightened uncertainty, these insights are invaluable for strategizing investments, forecasting future borrowing costs, and understanding the broader economic environment and impacts. As the clock ticks down to 2 p.m. Eastern, we'll put a timer up. Today's FOMC Minutes aren't just another piece of economic data. They're the pulse of the market today, the foundation for financial forecasts, and a glimpse into the minds shaping U.S. monetary policy. So we'll see what we get today. Let's put a timer up. We got about 37 and a half minutes or so. Oh my gosh, dude. I literally just got out the shower. Ugh. Another black eye for me, man. I could see it, dude. I could see it. Ugh. Ouch. Somewhere I got headbutted. That's all this only thing this could be is a freaking headbutt. I know it. I could feel it. Ugh. Yeah, I don't have cauliflower ear yet, although I've had to drain my ear once. I've only had cauliflower ear once. I had to drain it. NASDAQ's still technically on the green. You can see the NASDAQ pushing over the previous closing price, which is around 539.30s here. Alright, so Microsoft on Wednesday today debuted its Mojorana 1 quantum computing chip 2 months after Google announced its own chip as well. So Microsoft debuted their chip today. Markets are mostly flat ahead of this report. Microsoft is up, though. It's up to 411s today. NASDAQ's pretty much flat, slightly green. But, ugh. Oh, my gosh, dude. I'm sorry I keep talking about it, but I'm really kind of disappointed. I gave myself another black eye. Are there any indicators that are the same as for interest rates? Well, you can use bond yields, GG, to gauge what interest rates are going to do. I like looking at the 10-year yield. If the 10-year yield, so this is, again, I'm going to explain this correlation that I explained this morning on the morning stream. Okay, this is how you predict future rates. All right, or this is how you see sentiment around rates is probably an easier way to put it. Bond yields and interest rates have an inverse correlation, which means they do the opposite of each other. And so if bond yields are spiking, as they have over the past few days, that means that consumers and lenders think that interest rates are going to go down. Or no, I'm sorry. That's actually wrong. I'm sorry. Bond yields and interest rates have a positive correlation. So if bond yields are spiking, it means that interest rates are probably going to be going up. At least that's what people are expecting. It's a more hawkish stance. Now, the other correlation is that bond yields and bond prices have an inverse correlation. So if bond yields are spiking, the price of the underlying bonds are decreasing per supply and demand. And so if yields are spiking, it basically means interest rates, the sentiment is a hawkish sentiment, like a higher interest rate sentiment. If bond yields are going down, the sentiment is that interest rates might be falling, or this, that's what they expect at least. But they're a little bit of a different animal. They really are. But bond prices and bond yields inverse each other, and interest rates and bond yields parallel each other. So that's how you read it. Honestly, I'm pretty green today. I actually made some money this morning. So, like, I'm honestly pretty green today. Like, we ended up, like, I'll show you guys, like, check out my list of trades here in this account. Like, check this out. So, like, here's my Top Step X account today. Pretty good. Pretty good. I mean, it's certainly not perfect. These are all from today. Okay, these are all from today. Let me move myself over here. Look at these. So we got $25, $10 loss, $75 gain, $55 gain, $65 gain, $40 gain, $50 gain, $120 loss, $15 gain, 50-cent gain, $6.50 loss, $13.50 gain, $5.50, $5.50, $7.50, $55, $75, $75. And so what you can kind of see here is that I build up a cushion first, and then I start to increase size once I have that cushion built. Build up a cushion, take larger size. On this account specifically today, we are up $179 on this account. On my other account, we're up small on we're green on all three accounts today. But yeah, we'll see if that continues. I'm not really going to trade during the Fed minutes, to be honest. Microsoft, yeah, Microsoft's been a little underwhelming this year, right? They haven't really moved that much this year. And this is in a year in which stuff has kind of gone crazy, in all honesty. Like stuff, sorry, I bumped my mic. Stuff has kind of skyrocketed over the last year or two. And Microsoft's lagged behind a lot. And Microsoft's a powerful company too. When we look at a longer term chart from Microsoft, look how flat this year has been, man. It's been very sideways. Underwhelming versus a lot of other things. It kind of had some big pullbacks. But I think the PE ratio is still relatively low for Microsoft as well. But if you put up a longer term chart, I mean, this is the last 10 years of Microsoft gains. You know, Microsoft still, just since 2023, is up well over 100%. And so Microsoft's not doing poorly by any means over the last 3 years. Just this past years have been a little slow. But maybe them debuting their quantum chip might kind of reignite some optimistic investments in them. Is there any similar to the bond yields to gauge the meeting minutes report? I mean, you can look at a lot of different things. You can look at bond prices. You can look at like TLT. A hawkish stance would be TLT decreasing, which means the yields are increasing, which means interest rates are increasing. So you could look at like TLT and other bond ETFs for decreasing action, you know, based off of the same correlations we talked about earlier. You know, again, yields and interest rates follow each other, parallel each other. Bond prices and bond yields inverse each other. You can look at like VGSH, which is short-term bonds. I mean, typically you look at like the 2-year, the 10-year, the 30-year yield to see what interest rates are going to do. You can look at the yield curve. Yeah, TNX is what I look at as the 10-year yields. It moves parallel with interest rates. It's the most straightforward way, to be honest, for me. But everybody's a little different there. We got 30 minutes left. Look at the NASDAQ still pushing. That's a lot of information give out for free. I really appreciate it. Yeah, all good, man. That's what we're here for. Yeah, like, again, and most of the chat's genuinely supportive. Like, we get some bad apples that try to call me all kind of random names. Usually they're just mad about their own situation. But, like, we give away everything for free. I don't even claim to be a good trader. I just try to teach people about economics, economic reports, how to read the market in that way. I think that's a really important way to understand markets and finance. You got to understand bonds and Federal Reserve actions and what that means for the economy moving forward and how that affects stocks and other investment assets like futures. Once you start to gauge these things, understand like the correlation between bond yields, bond prices, interest rates, the Federal Reserve rate decisions, different economic stimulus measures like quantitative easing, quantitative tightening, and what the overall effects of that are on the economy and interest rates. Everything, the big picture comes together a lot easier, which essentially, again, if you want to really understand it, I'll try to go over it as quick as I can. The Federal Reserve is the bank that polices other regional banks and creates policy. That's why you hear like different Fed members, like, oh, Fed member blank, Fed member Steve. The Fed members are usually the heads of the regional banks. So there's like the Atlanta Fed. There's all these different federal heads that make up Fed members, and then Jerome Powell's the main one, like the chairman of the Federal Reserve. Now, the Federal Reserve's job is to create policy and influence the economy in different measures. The main way they do it is by controlling interest rates. So they will raise or lower, hike or cut the federal funds rate, which is short-term interest rates that banks charge each other to lend and hold money overnight. But eventually those rates that are influenced by the Fed will trickle into all the different interest rates you can see around the country. They're directly influencing adjustable rate loans, mortgages, home equity lines of credit, because those are loans that are based around these rates, right? So they directly influence those rates, but it'll also indirectly influence like longer term mortgages and stuff like that. And the idea is if the economy is weak, then the Federal Reserve could step in, bring interest rates down. When people have cheaper access to leverage and loans through lower interest rates, they tend to spend more, and that stimulates the economy. If it's a more desperate measure, like if something's really wrong in the economy, like 2020, 2008, 1987, I don't know if they did it in 1987, I have to go check, but they can do a more desperate thing called quantitative easing, which means that they basically print money, and they use the money they print. They create online banks, bank reserves, and then they use that money to buy up financial assets like bonds. And what this does is injects liquidity into those markets, and overall allows interest rates to kind of get settled down a little bit. Now there's a consequence. There's more of a consequence to that type of more desperate measure by the Federal Reserve, and the consequence is inflation. Now, keeping interest rates low as it is can spark inflation, because the more people spend, the more successful businesses are in terms of sales, the more they're likely to raise prices on consumers. And so it can have an indirect effect of inflation that way. But when you start to do quantitative easing and money printing in a more profound way, that can definitely make inflation much worse. And so it's a balancing act by the Fed, where if inflation starts to spike and they're starting to fear inflation, then they can instead do rate hikes. They can raise the federal funds rate, take away that cheap access to loans, and lower interest rates to consumers. And this will cause consumers and everybody, really businesses, to spend less, and ultimately lower inflation is the point of it. They could also do the opposite of quantitative easing, called quantitative tightening, which basically means they're taking liquidity away from the bonds and financial markets, and ultimately causing things to be a little bit more restrictive by letting their current balance sheet, like what they're holding, mature and run off by not supplying that liquidity. And so all of this makes it a little bit easier for the Federal Reserve to control interest rates, inflation, and overall the economy. But it's not a perfect science, and their job, if we could just keep interest rates low without any consequence, they would do it, but it's a balancing act, because people are really fickle and they're unhappy. No matter what happens, people are going to complain about the opposite thing. So if we keep interest rates low and inflation spikes and we do QE, people are going to complain about inflation. If we don't do anything and we let us go into like a recession or depression from the lack of economic stimulus, then people are going to complain about not having jobs or not being able to work. Or, even in situations like this, lenders are going to complain about interest rates being high because they are losing business from the lack of applications for mortgages and other loans. And so it's a really nuanced thing that kind of, it's a hard job by the Federal Reserve. But today we have what's called the FOMC Minutes report, which is a detailed breakdown of why they chose to make the decision that they did in the last Fed meeting, which was exactly 3 weeks ago. This happens every 6 weeks. Every 6 weeks, the Federal Reserve makes their rate decision. Their last one was a pause in interest rates. And if you want to see what the Federal Reserve is going to do at any point in time, like what the most probable thing is, you can always go to the CME Group Fed Watch tool. You can kind of see that tool here. This is what most financial and economic professionals use to gauge what the Federal Reserve's decision is going to be. And apparently a lot of people don't use this because a lot of people are wildly wrong about what they expect the rate decision to be, where if you follow this, you can kind of know what's going to happen. Like, you know what the Federal Reserve is going to do. If you look at this 30 minutes before the rate decision, for the most part, you know what they're about to do. So there's no reason to bet on some like wildly tiny percentage likelihood thing by the Federal Reserve. And if you look at this now, it's most likely that the Federal Reserve is going to pause interest rates in 3 weeks in March, which means they're just going to leave rates unchanged. You can see the bottom rates here is 4.25 to 4.5%. It's 425 to 450 basis points. If you want the actual percentage, you just move the decimal place over 2 spots from the right, and you'll get the actual percentage, which again is 4.25 to 4.5%. So yeah, that's where we're at now. Yeah, quantitative tightening is when the Fed reduces their balance sheet. What it's really, there's a couple different ways. You could do direct QT, which is just straight up selling bonds, unloading your balance sheet in a more desperate way. It's called direct QT, but that's usually not what they do. They're usually more balanced, and they try to do what's called passive quantitative tightening, which means they're just kind of letting, bonds have a maturity date in which they run off the balance sheet. It's when the loan is done, basically, through the bond. Passive QT is just when they let their bond holdings mature and kind of run off their balance sheet that way, instead of directly, more desperately kind of selling it, is what QT is. It looks like the Fed's going to start ending quantitative tightening pretty soon as well, at least according to Jerome Powell when he did their semi-annual monetary policy report to Congress. He said that their plan at this point is to start to roll out QT over the next couple quarters. We'll see if they actually do. This is always subject to change. Looking at Microsoft, though, Microsoft is pumping up. Gold is falling down a little bit here. I mean, this FOMC thing might move markets. We don't know if it will or not. We can only kind of guess, but it could. Yeah, bond prices are useful. If they pull liquidity, does it cause the market to channel? Not necessarily. One of the things you start to realize when you watch all this stuff is that the stock market and the economy are two completely different things. Now, they might influence each other, but in theory, when the Fed's been really hawkish after 2020. So what happened in 2020? The economy tanked, of course, because of everything going on, the lockdowns and all that stuff. Unemployment spiked, and the Federal Reserve did QE. They lowered interest rates to almost zero. Again, I go over this almost every economic stream, but I guess it's important for people to really understand it. If you look at the federal funds rate graph, right? If you look at the federal funds rate graph, you can kind of see what they're doing, and once you start to understand all the stuff that I'm saying, you can kind of see the different events in macroeconomic history. So here's a 5-year chart. Here's a 10-year chart. That's probably the easiest way. So look, in 2020. So in 2020, you can kind of see right here, this flat area, the Federal Reserve basically brought interest rates down to almost zero to try to save us from the looming recession and depression of 2020. So they brought interest rates down to almost zero, and the consequential effect of it on interest rates were going down. The consequential effect on inflation was that inflation, if you look at CPI inflation following this, inflation spiked. Look, here's you can kind of see inflation spike up after all this because rates were so cheap. There's a lot of reasons inflation spiked after 2020. Part of it was supply chain restraints. There were issues in supply, shipping things. Factories were shut down. Everything was kind of struggling. But one of them was certainly from rates being low, and as well as the quantitative easing that occurred to try to save us from the looming depression, recession. And so what the Fed did was they started doing rate hikes once inflation spiked up to 10%. And so just to put myself a little bit higher here, you can kind of see they started raising the federal funds rate right here. And they raised the federal funds rate consecutively up until August of 2023. And then they paused for a straight year. If you guys remember this, every single Fed meeting, they were pausing. They weren't lowering rates. They weren't raising rates. They kept rates the same. And then in August of last year, they started cutting rates. And from August to December of last year, they cut rates by a full percentage point. It might have been more than that. It was 50, 25, 25 actually. So it was 50, 25, 25. So it was a full percentage point. And now we paused last meeting. So in January, we paused. And then in March, it looks like we're going to pause again. It doesn't look like we're going to do anything besides a pause until... it doesn't look like we're going to do anything besides a pause until... What is it, July now is what they're expecting by the Fed. Like, we're going to pause interest rates until July. Carvana earnings today. That's interesting. Yeah, I don't know what the market's going to do. Like, the market's right around all-time highs. Again, if you look at the NASDAQ here, all-time highs are at 541. We're at 540 basically right now. So the NASDAQ's around all-time highs. I have no freaking idea what the NASDAQ or anything's going to do. Yeah. Yeah, y'all hit that like button. Hit the subscribe button. We got about 1,100 people watching. Yeah, y'all hit the sub button. Again, I'm just here to help people. Like, if y'all want to learn a place that doesn't cost anything and that we don't sell a course, I don't sell a service. I don't even claim to be a good trader, but you can watch me trade every day. I invest, I swing trade. We do a lot of stuff. Hit the subscribe button, hit the notification bell. I appreciate it. Hey, thank you, DF. Hey, thank you, Max. And again, guys, listen, it's not super difficult. It's kind of like The Big Short. You know how The Big Short talks about how bankers use all these big words to discourage people from getting involved so they don't end up making money, so they don't have to share the wealth? That's basically what it is. But if you understand those 4 things, okay, understand the correlation between bond prices and bond yields, which is inverse. If yields go up, bond prices go down. First correlation you want to understand. Second correlation is understand the correlation between yields and interest rates. They parallel each other. If yields go up, interest rate sentiment is up. If yields go down, interest rate sentiment is down. That's the second correlation. Understanding those two correlations are all you really need, you know. If you can understand those 2 correlations, that's all you really need to know. And then you can use that to track what interest rates are doing, understand what rate decisions mean by the Federal Reserve, and understand what economic stimulus like quantitative easing, quantitative tightening is, and the consequential effects of it. Understand those 4 things, you'll understand economics for the most part. And you just learn where you find the stuff. Watch the CME Watch tool. It'll tell you where everything is. You can subscribe to my channel. I mean, I'm going to cover every macroeconomic event that we got. Fed decisions, Jerome Powell meetings, CPI inflation, PCE inflation, what it all means, you know. What the market wants at any given period of time we're going to speculate on. Do you think AMD is a good investment? What's AMD's EPS or PE ratio right now? I think it's still pretty high. It's not as high as it was years ago. Let's take a look. Yeah, AMD has a PE ratio of approximately 116. That's very high. That's very high. I mean, I think long term it's not going to matter, but short term it's a little high for me personally. Stocks and bond prices. So it's not always the case, Aaron. Like, usually it depends on what the market wants. Like, an example is right now the market wants rate cuts. Anything that can signal more rate cuts the market wants, because rate cuts mean cheaper access to money, and stocks love money, you know. But bonds and stocks can inverse each other because one's seen as risk on and one is seen as risk off. Like, bond prices or bond yields are guaranteed. And so, like, if you buy a 10-year and the yield is 4.5% annually, it's guaranteed by the U.S. government if it's a treasury bond. And so in that regard, bonds and bond prices are considered safe investments. And so if the market is really volatile, you can watch something like the VIX. If the market's really volatile, people are, you know, less likely, depending on what we're considering volatility, to invest in stocks, and they're more likely to invest in bonds. if risk is on and people want to take more risks, then they might go against bonds and, you know, and invest in stocks. And so there can sometimes be inverse correlations between bond prices and stocks. But in that regard, there'd be a positive correlation between bond yields and stocks as well, because when bonds are doing poorly, typically the yields go up to entice people to buy bonds and not to buy stocks. So there's a lot of nuance, but yeah, kind of. Sometimes it's not always 100% definitive though. Like the correlations between the two, they can move. It's kind of like the dollar index. The dollar index can go with the market, it can go against the market. It all depends on what's going on. So the VIX is volatility, Max. So typically, usually we see volatility in bearish action, right? So if you want to read the VIX, you can kind of look at what it's doing now. So like these spikes are usually when we see big percentage drops in the market. All right, so that's how you read the VIX. Meaning if the VIX is high, it typically means the market is falling drastically in a volatile way, right? Like DeepSeek happened right around, if you look at these dates, they probably correlate with big catalysts, big negative catalysts in stocks, right? And now with markets at all-time highs, the VIX is very low. It's very cheap. You know, it's very, very down because the volatility is curbed. Things are looking good. When we have big negative catalysts like DeepSeek, you get these spikes, you know. The yen carry trade, like stuff like that will make the VIX spike. It's volatility. So is pausing rates hawkish? It's kind of a neutral stance. I think it's going to be interpreted as hawkish because it means we haven't quite pivoted fully to a more dovish stance. But technically it's neutral. It's no change in interest rates. I would say if the Fed's doing quantitative tightening currently, which they are, and we pause, it's more hawkish than dovish because it's a pause with quantitative tightening continuing, which is a little bit more hawkish, but again, it's kind of neutral. Rates aren't crazy high right now either. Like, you know, lenders are going to act like rates are just ridiculous because they're so used to the low interest rate environment of the last 10 years. But when you look at historical averages, interest rates are not that bad right now. They're really not. They could be much, much worse. All right, guys, we have 12 minutes. 12 minutes. Okay, get ready. We're going to cover the FOMC Minutes report. We're going to use AI to break it all down so you can guys understand everything going on in markets. Oh, dude, I can't believe I got another black eye, bro. It hurts, too. This genuinely hurts. Ooh. It's going to be black. And we can look at Bitcoin too. There's the VIX. We'll leave the VIX up. These are some good correlations. So we'll leave the VIX up. We'll leave the 10-year up because I'm curious to see what the 10-year is going to do. And then we'll look at the NASDAQ futures market here. So we'll put these all three up. And then we'll put, because these are really good to gauge kind of interest rates here. We put a 1 minute chart, 1 minute chart, 1 minute chart. Okay, that's good. And then we'll put... And again, we're very green today on everything. So we're green in every account that we have right now. And then we'll put our full screen up here. I'll probably document some levels. I want to see what the market does. Market's still pretty flat, though. Pretty range bound. All right, guys, again, stick around. We're going to cover the FOMC Minutes report very soon. It's only 10 minutes left. We got about 1,500 people watching. Let's see if we get up to 3,000 people today. Let's try. Yeah, I mean, we're going to pause in March. The only way we wouldn't pause, thinking about the correlations, the only way we wouldn't pause is if inflation comes in good, like low, and the economy looks much more weak than expected. It's the only way we're going to pause, or that's the only way we're going to do anything besides pause, I mean, is if economic looks weak. Like if the market turns to where recession and depression is a risk somehow in the next month, which is very unlikely. It's 3 weeks from now. These happen every 3 weeks. You either get an FOMC minutes report or a Fed meeting every 3 weeks. Every 6 weeks, you got a Fed decision. Every 6 weeks, you got an FOMC minutes report. But in that regard, every 3 weeks, you get one of them. Because the Fed minutes report always happens 3 weeks after the Fed decision, which was 3 weeks ago. You know, and then in 3 weeks from now, we're going to get the actual FOMC minutes or FOMC decision. And so today we have the FOMC minutes report. Put this up on screen. All right. I'm going to zoom in a little bit so you guys can actually see the charts a little bit better, I think. That's what I'm going to do. It should be pretty good. Zoom in a little bit. Does that cut the VIX off? I think it might. Hold on. There we go. That's perfect. And then we'll slide this to the right a little bit. Create a little bit more space here so you guys can actually see the prices. Yeah, I think that's good. All right, cool. That's perfect. All right, so we got the VIX, which gauges volatility based off of the Fed minutes report. We got bond prices. So if you want to see what interest rates are going to do today, guys, or you want to see how the market's interpreting that, if this here goes up, that means they think interest rates are going to be higher. Okay, these are bond yields. If this goes down, that means they think interest rates are going to be lower. Okay, watch this middle chart here. Bond yields. If you want to look it up yourself, it's the TNX 10-year Treasury yield. If this goes up, it means higher interest rate sentiment. If this goes down, it means lower interest rate sentiment. Yeah, give me a follow on X. There's my X position. There's my X page there. Go give me a follow. Completely free. Doesn't cost a penny. We got about 2,000 people here. We got 7 minutes left. Completely free. Doesn't cost anything. We're going to break it all down live on stream as we always do. And we do this every single time. We give this for free. Yeah, Palantir's PE is way too high for me personally, but it doesn't mean I don't like it. It just means it's too high. All right, I'm gonna put like Bitcoin up right here actually, and then I'm gonna move the timer somewhere else. Hey, thank you, Aaron, my guy. Thanks so much. I haven't eaten lunch yet. I just got back from jiu-jitsu. I gave myself a black eye. And so I didn't give myself a black eye. Somebody need me somewhere. My friend Lance said he need me, but I didn't feel it at the time. He like apologized. He was like, "Oh no, I think I got you." And I didn't feel it at the time, but maybe he did. More so, I think it was Grady. He's a brown belt. Very good brown belt. I rolled with him last. I'm pretty sure that's where this happened. All right, guys. Hey, 6 minutes. All right, guys, and again, we're going to break everything down. We're going to fully summarize the Fed minutes report very, very quickly. And so stick around. And we're going to summarize future projections first from the Fed minutes report, giving you a little bit more information. All right, guys, 4 minutes. 4 minutes. We got about 2,300 people already. Hey, thanks so much, guys. Is this report important? Well, it depends on... It's all relative. Some people are going to consider it important. Others are going to consider it nothing. So it just depends. I can put the Dixie up at the bottom instead if you want. I like the VIX. So this is not the FOMC meeting. This is a... I don't think you can tap me live 0. I think you probably get tapped out. But... you could try. I just got my blue belt like a couple weeks ago. But I still think I can take you. My confidence is high. That's all I'm saying. John is running a small stadium. I mean, we got almost 3,000 people here. That could probably fill a stadium, huh? All right, guys. Hey, 3 minutes. Almost exactly 3 minutes left. And again, if you haven't already, check out Top Step. If you want to learn to day trade, check out Top Step. Before we look at this, understand I'm not an investment professional. I have no freaking idea what I'm talking about. I might be wildly wrong about anything and everything I say. Understand CFTC 4.41, hypothetical or simulated performance, have limitations. All right, guys. Again, if you want to check out Top Step, try to day trade, here's the link. Great way to learn how to day trade in the futures market, the most legit funded program in the world. They give you a demo, test your skill. You pass it, they fund you. You fail it, you only lose. Base one's $49. They're an affiliate, though I'm biased. I get paid by them, so naturally biased. Shameless plug. If you want to check it out, link is in the chat. All right, guys, we got the FOMC Minutes report. This is a detailed breakdown of the last FOMC meeting. The last FOMC meeting, we paused interest rates. It's 97.5% likely that we're going to pause interest rates again in the next meeting. The market wants lower interest rates, and the Federal Reserve is not going to give it to us, I don't think, in the next meeting. This is an important report because it'll give us a detailed breakdown in why they chose to make the decision that they did in the last FOMC meeting, as well as potentially future projections about the Federal Reserve's, sentiment and interest rates, what they plan to do over the next 6 months. Right now, the likelihood is that they're not going to start cutting rates down until July of this year. But that could always change. It's always subject to change. And again, if you want to understand the correlations here, guys, this middle chart right here, I'm going to put just 2 charts up. All right, I'm just going to put 2 charts up. I'm sorry for anybody that might get mad at this. I'm going to put 2 charts up. This bottom chart right here, okay? If this goes up, it means traders think interest rates are going to be higher from this report. If this goes down, it means traders, investors, and economists think interest rates are going to be lower. These are bond yields, and interest rates follow bond yields, or at least the sentiment around interest rates is parallel to bond yields. So again, TNX goes up, hawkish interpretation. TNX goes down, dovish interpretation. We got 40 seconds left, chat. 40 seconds. All right, here we go. 20 seconds. All right, guys, you ready? All right, here we go. And the release is in 5. This timer's a little bit early. 4, 3, 2, 1. And here we go. All right, guys. All right, give me a second. We're using AI to break this report down right now. Bear with me. Okay, bear with me. All right, guys, bear with me. All right, so market so far has reacted negatively to this report. Negatively to this report. Bond yields haven't really moved much. But, again, we're going to start breaking this down. Yeah, so I'm looking at this report. All right, so again, we're breaking this report down from AI, so bear with me. Okay, so again, guys, we're reading this now. It took a second for AI to break it down, but here it is. So again, stick with me. Very long 12-page document. All right, guys, so we got a couple of cliff notes that we're going to talk about on this report. Again, we're going to use future projections, and we're going to put this out first. Okay, future projections, and we're going to put this out first. All right, so first thing, the last meeting, the Federal Reserve paused interest rates. They paused interest rates. Okay, they brought interest rates down to 4.2, or they paused them at 4.25 to 4.5%. All right. Again, the likelihood when we look at the CME Watch Tool reaction, number one, the market is slightly reacting positively to this report. The Federal Reserve staff projected that economic growth would remain solid in 2025, so they think the economy is going to be strong. The output gap is expected to narrow until early 2026. The unemployment rate is expected to stay close to its natural rate so far, reflecting a stable labor market. However, they emphasized high uncertainty regarding policy changes, including trade, immigration, fiscal policies, which could impact the economy and economic activity. Inflation expectations are expected to remain stable in 2024 with potential upward pressure from trade policy changes, basically the tariffs that's going on right now. Inflation is projected to gradually decline to the Fed's 2% target by 2027. And while overall uncertainty was deemed average compared to the last 2 decades, risks to inflation were seen as skewed to the upside. Yeah, so again, inflation expectations skewed to the upside. Core inflation in 2024 remained higher than expected, and any new tariffs or supply chain disruptions could push inflation higher than anticipated. The outlook for monetary policy remains data dependent, and the Fed's going to monitor incoming things. So when the participants looked at they said it was appropriate to hold rates. Staff's economic outlook largely unchanged from the one provided at that December meeting. So basically, they're very flat from this meeting. Although the market has reacted positively, the VIX is not really doing anything. Yields have not really budged at all. Again, the labor market was assessed as stable. Employment growth averaging 170,000 per month at the end of 2024. Unemployment remained low. Wage growth moderating. Participants viewed as reducing inflationary pressures. However, there were concerns that financial strains among lower income households could impact consumer spending. Some members pointed to a strong consumer demand, potential tariffs, and changes in trade and immigration policies as factors that could slow inflation progress. Economic expansion remained solid, supported by strong labor markets and wage growth. Business investment slowed in late 24, but favorable supply chain developments, including productivity gains, kept business sentiment optimistic. However, financial conditions tightened with higher treasury yields, mortgage rates, and corporate bond spreads, potentially slowing economic activity. Participants agreed the financial conditions warranted close monitoring, especially in relation to future interest rate decisions. So let's talk about inflation and the labor market conditions. Inflation showed signs of progress with total PCE inflation at 2.6% in December, core PCE at 2.8%, which is the Fed's preferred one. The recent slowdown in inflation was attributed to lower good prices and declining housing services inflation. However, some non-housing services categories remained stubbornly high in inflation. Participants noted that potential tariff increases and geopolitical disruptions could add to inflation and pressures. The labor market was strong, though. Stable payroll growth, low unemployment, wage growth continued to moderate, easing inflation concerns as well, though. Business surveys indicated that firms expected stable employment levels and only moderate wage increases in 2025. However, participants noted that high borrowing costs and financial constraints on households could impact future trends in employment. They judged that under appropriate monetary policy, inflation should continue moving toward 2%, but progress could be uneven. Emphasized the importance of maintaining restrictive policy to prevent resurgence in inflation. Most members favored a cautious approach to future monetary policy adjustments, waiting for confirmation that inflation was sustainable. So as of January 25th, the FOMC voted unanimously to maintain the federal funds at 4.25%. to 4.5%, reflecting a wait-and-see approach and inflation and labor market trends. The committee reaffirmed its commitment to reducing its balance sheet. So here's quantitative tightening. The committee reaffirmed its commitment to reducing its balance sheet with ongoing roll-off Treasury and mortgage-backed securities. They emphasized that monetary policy decisions remain data-dependent and that additional rate cuts would require clear evidence of continued disinflation. They noted financial conditions had tightened, equity valuations remained high, providing some economic support with high stock prices. Some members suggested that policy could remain restrictive longer if inflation risk persisted. Others argued that rates could be lowered if economic activity weakened. Uncertainty warranted. Most people agreed, like most of the Fed members agreed, though, that policy uncertainty warranted a cautious approach, the Fed needing flexibility to adjust depending on economic conditions. And again, looking at yields, guys, so yields are dropping right now. So yields are dropping. Which means that people are a little bit more optimistic in interest rates. So again, you can kind of see the 10-year dip here. And you can kind of see a positive reaction in stock and NASDAQ prices here. Again, the Federal Reserve remained focused on balancing inflation control with economic stability. Inflation is moderating, risks maintained, particularly from potential policy changes and external economic shocks. Restrictive but flexible is the Fed's mindset right now, most people are saying. And so, yeah. Let me check the chat. That is basically what is going on. Again, just to reaffirm all that stuff, re-talk about it here. Again, I had future predictions first. Federal Reserve projected economic growth. Again, the Fed projected economic growth would remain solid this year in 2025, while the output gap expected to narrow until early next year in 2026. Unemployment rate expected to stay close to its natural rate, reflecting stable labor markets. Staff emphasized high uncertainty regarding policy changes. Basically, they don't freaking know. Including trade, immigration, and fiscal policies could impact economic activity. Essentially what they're saying here is that with all the tariff stuff looming and glooming, they don't freaking know, is what they're saying. Inflation is expected to remain similar to last year. The potential upward pressure from trade policy changes is what's causing that. It is expected to gradually decline to the Fed's 2% target by 2027, though. Overall uncertainty was deemed average compared to the last 2 decades. Risk to inflation were seen as skewed to the upside, though, so there's still upward risk to inflation, especially if tariff drama starts. Core inflation in 24 remained higher than expected or wanted. Any new tariffs or supply chain disruptions could push this higher than expected this year, is what they're saying. Outlook for monetary policy stays data dependent, is what the Fed said. So yeah, they said most of the participants in the Fed said it was largely appropriate to pause rates. And again, what we do see from this report, guys, that we see bond yields decrease, which does mean people are a little bit more optimistic in sentiment for interest rates. They think interest rates might be going down some. Because again, interest rates and yields tend to follow each other. We have stock prices decreasing here. And so interesting nonetheless. Do y'all think this is hawkish or dovish? I'm going to end this poll and we're going to do another poll. I'm going to show you a poll here. Did you think this FOMC meeting minutes report was hawkish or dovish? Vote on this poll. I'm curious to see what people think here. We just got that poll live right now. Vote on the poll. 53% dovish, 49% hawkish. Pretty split though. Dovish is kind of... Okay, we got about 200, we got 300 votes, 350, 370, 57% think hawkish, 60% think hawkish now. So interesting. Vote on the poll. Let me know how you feel. Just to give you guys a shameless plug real quick, we're going to keep monitoring markets. Interest rates are still, people are more dovish right now in interest rates. You can see the TNX dropping here, which means that interest rates sentiment is going down, more dovish. But again, a shameless plug. If you want to learn to day trade, you got a couple options. You can either fund your own account, and let's be real, you're probably going to lose it. If you deposit 5, 10, 20, 30 grand into your own account, trying to day trade stocks, you're probably going to lose it. Instead, try futures. There's no PDT rule. You can day trade the S&P, the NASDAQ, the Dow, the Russell, gold, some currencies, no PDT restrictions, and Top Step is the most legit funded program in the world. If you were going to pay for a real-time demo account in futures, it might cost, what, 20, 30, 40 bucks, 50 bucks? Top Step's base package is $49. With that, they're going to give you a $50K demo account. If you can make $3K in profit without losing $2K first, following their rules and conditions, and I can't guarantee anything, you want to confirm it with them, they fund you $50K with a 90% split. and that you get to keep your first 10K in profit and 90% after that. That's very similar to funding your own account, the split that is. But if you fail this, you're out $49. If you fail it, you can also use a practice account. And if you were going to pay for a practice account in a similar way with real-time data, in some places they're going to cost about the same ballpark. So the value is there, but it teaches you how to day trade following rules. It's kind of like a souped up demo account. It teaches you how to day trade. The patterns in futures are very similar to stock patterns. No PDT restrictions. Just overall very similar to day trading stocks. And listen, most day traders lose. That's probably the same here. Most day traders are going to lose because that's just what happens. It's a lot cheaper to lose $49 than it is to fund 50, 30K into your own account and lose most of that. And that's what happens. Most day traders lose. They are an affiliate of mine. I am biased. I get paid by them. So I'm top 3 most biased person ever. Understand CFTC 4.41 hypothetical or simulated performance have limitations, guys. I'm not an investment professional. I'm not liable if you lose money. Understand all this stuff. Most day traders lose. Frankly, it's a lot cheaper to lose here than it is to lose 5, 10, 20, 30 grand funding your own account most of the time, at least. Although, again, you want to confirm it all with them. If you want to check it out, you can get 0 commissions on Top Step X. When you use my link, if you go to Top Step X, 0 commission. No PDT rule in futures. There's the link in chat. Great way to help support the channel. Top 3 plugs ever. Oh, yeah, I definitely make money doing this. Of course I did. Top 3 everything. Definitely top 3. Yeah, most day traders lose, guys. That's just the truth. Most day traders lose. Again, bond prices continuing to go up. Let's look at TNT. So TLT. Bond prices are going up. The yields are going down, guys, which is a dovish move. People are reacting in a dovish way to this. Interest rates might be falling according to the TNX. So, again, a more dovish reaction by the Fed minutes report. More dovish reaction. Yeah, I mean, I certainly make money doing this. I mean, I'm not sitting here out the kindness of my heart. Nobody does. Anybody that claims to is lying to you. I'm doing this to make money 100%, but I'm providing a service. And I think a large majority of people would agree what I'm giving away for free is valuable. And so you better believe I'm going to make my money on the back end of it. That's pretty understandable. If you were me, you would too. And so, you know, you can cry about it, but this is the nature of business, you know. Most of the time, it's got to do with yourself, not me. So cheers to you guys. I appreciate the love. Thanks so much. We still got 4,000 viewers here. Thanks so much, team. And again, what I read is the Fed is basically saying, I don't freaking know what's going to happen this year. They don't know when they're going to cut rates. They don't know what that's going to look like. And my guess is the reason they're taking a really data-dependent approach here is because they don't know that we got a new administration. Tariff news and stuff has been going on. DeepSeek, all kind of stuff has been volatile in markets. They don't know how that's going to overall affect the economy, markets, or anything else. What we do see is we see stock prices rising right now, and we see bond prices falling. Bond yields falling, which means that the interest rates are expected to be decreasing, or at least the sentiment around interest rates is dovish. And that would make sense why stocks are up a little bit from this report as well. And so again, a dovish reaction in interest rates and yields, and the Nasdaq's pushing up, popping up high here, guys. Looking at our poll numbers, 59% think it was hawkish. Interesting. 42% think it's dovish. Yeah, I don't want anybody to copy my trades, James. If anything, I'm top 3 worst trader ever. Don't copy me. I have no freaking idea what I'm talking about. Look at the scroll at the top of the screen, guys. I have no idea what I'm talking about. Don't copy me. I'm not an investment professional. I don't even know what an investment professional is, but I'm definitely not one. And if you copy me, you might lose. Don't do it. Look at the market rip. Look at bond prices go up. Look at yields decrease. This is a dovish reaction here, guys. This is a dovish reaction is what this is. Yields are going down. Stocks are going up. Underlying bond prices are going up. Yields are going down. This means interest rates are falling, which is good. I'm for it. Come on down, interest rates. Look at the market spike here, guys. Wow. Look at the Nasdaq rip. Dude, what are you giving away for free? Summarized economic reports, inflation data. You know, we just broke down the full Fed minutes report pretty quickly. cover the market reaction to it. I don't even claim to be a good trader. We cover economics here, you know. You don't like these bounces? Why not? Yeah, will the market break highs again? Market's right around all-time highs here too. Nasdaq's pushing up again. Chad, just to clarify, I'm gonna give you guys the big correlations to understand. Okay, understand bond prices and bond yields inverse each other because it's supply and demand, right? So you can see TLT going up. These are 20-year or longer-term bonds, but we're gonna look at the correlation anyway. TLT's increasing, bond yields are decreasing. And why is this relevant? Because bond yields and interest rates, which is what the Fed Minutes report is gauging, run parallel to each other. And so what does this mean? This means potentially lower interest rate environment, potentially more dovish Federal Reserve, as long as we get good inflation data to justify it. Potentially a more dovish Federal Reserve. If we take a look at the CME watch tool here, again, if we take a look at the CME watch tool, these percentages haven't really changed from this report. So we're still at 97.5 to 2.5. So again, this is the likelihood of the Federal Reserve rate decision in 3 weeks. Still 98% likelihood that we're going to pause interest rates, that we're going to leave rates unchanged at 4.25 to 4.5% down here. So and so again, spikes in markets, spikes in bond prices, dips in interest rates and yields, which is overall pretty good. Does that all make sense? Hey, what's up, Kratos? Nice covering, buddy, from the UK. Thank you, Clint. I appreciate it, brother. If you get 200,000 subs, free giveaway? Sure. Yeah, the dollar index inverses the stock market certainly sometimes storm. There's a lot of reasons for that, but it's not always the case. It sometimes breaks it down. It sometimes breaks down and does the opposite way. Like, we don't really know. I will day trade some for you guys, but again, remember, I have no freaking idea what I'm talking about, guys. Do not copy me. We will try to day trade today in this account. I kind of want to buy this dip. No, hold on, let's try. Is it a dip buy or a dip sell, guys? What do you guys think? I'm gonna buy into this, I think. Kind of volatile. We got 2 contracts here. There we go. We got a nice little retracement. I'm gonna immediately take half of this off. Just lock it in. I'll add some more since we're nicely green on this. See if we can pop up some more. Give me a little bit more. There we go. Take another half off here. Lock it in. I'm gonna cut the rest there. Just made about $20. Very small, but baby steps. On this account, we got to build up a cushion. The other account, we're up a couple hundred. This one, we're up small. Should I buy it again? Oh, I signed in on another account. It locked me out. It's all right. I don't know why it does that. It used to let me. It's the same computer. Oh, well. Buy, sell, buy, sell. I made money in NVIDIA. I didn't lose money. If bond yields decrease, it means that interest rates are decreasing with it, which is typically a more bullish thing for the market and the economy, which gold can kind of go either way. It depends on which way you're looking at gold. Gold kind of long-term follows markets. Look at bond yields decrease even more. Guys, very dovish reaction by the Fed. Very dovish reaction. Gold's kind of a different animal. Gold will kind of macro follow the market, but it can also do the opposite of the market if we have deep fear as well. So it's gold is the correlation is less easy to predict, to be honest, in gold, because gold can go up with the market or it can go up against the market too, depending on what the primary catalyst is to spark it. I should have held that position a little bit longer. Deep fear just means like a big catalyst that can make people fear economic weakness. Wow. Look at this big spike. I should have held that long position. I mean, we're green though, so we're doing okay. I appreciate to everybody that followed me on X. Appreciate the love. We're kind of growing a little bit on there. It looks good. Let's see if we can... All right, so we're going to give you guys another summary of the sentiment regarding the recent Fed minutes report. Cautiously optimistic, data-dependent markets interpreting the report as signaling a higher for longer stance on interest rates while keeping the door open for future cuts if inflation continues to ease. I don't know, man. You know, AI is giving me the summary, but when I'm looking at yields, you know, again, yields are decreasing. So yields are going down on this report. Here's where the report dropped right here. And then yields have basically decreased as soon as this report dropped. You know, so that wouldn't signal higher for longer. This honestly signals more optimistic regarding rate cuts, a more dovish reaction. So I think AI is actually wrong here, but they were definitely data dependent. Yeah, why are y'all spamming? You're wrong about gold? In what way? In what way am I wrong about gold? We could talk about it. I mean, maybe I am. I certainly could be. I might be wrong about it. I don't freaking know. Gold is kind of a different animal. Gold can uptrend and downtrend for decades, you know, against the market, with the market. It doesn't necessarily have to move in any specific way. And so when we're looking at like gold, if something shows inflation, people hedge with gold, right? And so in that regard, gold would be moving if bond prices... Gold should be moving down on this report. But who knows? Again, gold's not really my specialty, guys. I'm certainly not a gold expert. Top 3 in the world, but definitely not. Why was it dovish? I'm looking at yield reactions to interpret hawkish dovish. Because again, yields and interest rates follow each other. And so if yields decrease, that means they think interest rates are going to decrease. And that is a dovish thing. Low interest rates is a dovish Fed, less restrictive. So there's no FOMC meeting today. This is a reaction to the last FOMC meeting from January, guys. Again, no FOMC meeting today. This is a reaction to the last FOMC meeting from January. Gold. Yeah, where's the spies? The spy. Everything looks pretty optimistic. It looks good. Any other questions, guys? You know, put some of the summaries up in chat. Where's SPY going? Dude, I got a new black eye today. I can feel it, bro. I can feel it right here, dude. Like, look at this. It's swollen. It hurts right here. Oh, wait, you can see it, dude. Look at it, guys. Look at it. Look at this. Dude, I swear, this is like literally like my 8th black eye this year. Ugh, man. How are you down 60-70%, eh? Thanks for explaining. Yeah, all good, brother. All good, man. Again, guys, like I'll give you guys the correlations again to understand finance. Okay, the Federal Reserve controls interest rates. They're kind of like the big bank that creates policies for the other regional banks that all have their own heads, like Atlanta Fed president, whomever. These are all the regional banks. Jerome Powell is kind of like the leader of the Federal Reserve that influences and policies other banks. They control interest rates, and if the economy is weak and they think that they need to save the economy from some weak economic disaster, they will bring interest rates down. If they think inflation's a problem, they can raise interest rates. And the logic of it is when you bring interest rates down, people have cheaper access to loans and money and leverage, so they tend to spend more because they have cheaper access to loans. That stimulates the economy. So if we're in an economic weak spot, we can bring interest rates down, stimulate the economy through low rates. If it's a really desperate measure, that we can print money, buy up a bunch of bonds, inject liquidity into markets. And that's called quantitative easing. But the consequence of that is inflation, which is what we saw after 2020's quantitative easing. If inflation's a problem, the Federal Reserve can be hawkish, and they can raise interest rates to try to discourage spending because we're taking away that cheaper access to money. So people spend less because they have less of it. Businesses spend less because they have less of it. And so they tend to, it can contribute to lower inflation. If it's a more desperate measure, again, like 10% spike in inflation following 2021 and 2022, the Fed will do quantitative tightening, which is kind of the opposite of QE. If QE injects liquidity, quantitative tightening takes away liquidity. And, really, it's a little bit direct. QT is straight up selling bonds and other financial assets. But the Fed usually does passive QT, which is what they're doing now. You could hear them talk about it in the FOMC Minutes report. This is basically just letting their bonds mature and run off their balance sheet that way. It's called passive QT. And again, that's what the Fed does. They influence rates and monetary policy in that regard. And today's Minutes report is just a detailed reason on why they did what they did. The last meeting was some future projections. Again, they tend to think inflation's a risk moving forward. But they're data dependent and they're very kind of middle ground from this report is what I see. And again, bond yields did drop, which means they think interest rates are going to go down with it, which is good. It means lower interest rates, a more dovish tone. But it doesn't mean anything quite yet. These are just the initial kind of knee-jerk reactions from it. We could do anything here. So I hope all that makes sense. We're trying to help you guys understand what all this stuff means. You hear people talking about it. And again, once you understand the correlations, it becomes easier. Yields and bond prices inverse each other. So bond prices per supply and demand, if you think about it, bond prices go up, yields go down, yields go up, bond prices go down, interest rates go down. It also depends on what the market wants. Sometimes stocks and bonds can inverse each other as well because bonds are seen as a safe haven asset because it's guaranteed returns in bonds versus higher yield returns investing in stocks, but it's not guaranteed. And so it depends on what the market fears, what's going on there, inflation, a lot of nuance behind it. But if you understand just those basic correlations, again, yields and interest rates follow each other, bond prices and bond yields inverse each other, and kind of what inflation and interest rates, the impacts of inflation on interest rates and stuff like that, it becomes easier to understand and watch and follow. These are just self-drawn resistance lines on the chart. These are just self-drawn support and resistance lines. I leave them on the chart because they tend to work fairly well. I can't guarantee anything, of course, but I drew all these lines out for the most part earlier this morning, and the market's mostly followed them pretty well. I use them to guide me on my trades, which today's been pretty good. Again, here's my trade list just to show you guys. This is the account we probably did the best on today. But again, you can kind of see my P&L here. We made 25, lost 10, made 75, made 55, made 65, made 40, made 50, lost 120, made 15, made 50 cents, lost $7, made 13.50, made 5.50, made 5.50, made 7.50, made 55, made 75, made 75. Total today we're up a couple hundred on this account and a little bit more on the others. So doing pretty good. I am trading on Top Step's funded account program. I mean, I got money everywhere, but Top Step is great for day trading because it limits your risk. If you pass, again, it teaches you how to trade and follow rules. Again, I'm a marketer, so I make money marketing. This is what most people on YouTube are, as marketers. And so you got all these people being catty and dramatic and all this stuff. Like I don't really care about any of that stuff. Like I'm a marketer, but I try to teach people about economics and day trading and swing trading and investing. And most day traders lose absolutely. And so I think using funded account programs is a way to hedge against that risk. You're still probably going to lose, but you're probably going to lose less if you try to use a funded account program versus funding your own account 5, 10, 20, 30 grand. Let's be honest. Anybody that's real with you is going to tell you you're probably going to lose most of your money that you invest in day trading. On Top Step, it's just noticeably cheaper, and you get that market experience. You feel the pressure, but if you lose, it's not the end of the world versus losing 10, 20, 30 grand, which might basically genuinely cause problems. Day trading's tough. It's difficult. Most people lose. But again, if you want to check out Top Step, I'm biased. I get paid by them. Like I said, I'm a marketer. And so if you want to check them out, here's the link. This is the last plug I'll do. Understand CFTC 4.41. Hypothetical or simulated performance have limitations. Understand I have no idea what I'm talking about. I might be wildly wrong about everything I say. Don't copy me. Certainly not an investment professional. Understand CFTC 4.41. And if you want to check out Top Step, link is in the chat. How often do you win versus lose? Let's see. Let me take a look at this account. So the account that I'm up a couple hundred on, my accuracy rate total is about 61%. My second account, my accuracy rate is about 65%. My accuracy rate in my other account's about 60 even. So about 60, 65% is usually, like, look, I'll show you the percentages here. And then I'll cut out. So let me see if it lets me zoom in here. So here's my interest rates pulled, or my win rates. It should let me zoom in, I thought, right? Zoom. There we go. Yeah. Okay. There's no more efficient way to do this. I would assume there's a better way to do this. Okay, but yeah, you can kind of see. Let me make sure y'all can see it. Here is this one doesn't count, so this is just a challenge account. So this is the one that's not funded yet, so that one's insignificant. But 60% on one, 64% on the other, 61% on the other one. It's roughly what we win or lose so far. But again, I can't guarantee anything. Anyways, guys, I'm gonna bow out for the day. Hope you guys are y'all red or green on the day? Yeah, I feel you, bro. Do you? You break. Do what you do, man. I think you got to understand most day traders lose, though. And so in the end, it won't matter because most people lose. Top Step's just a way to learn with less risk. Most people lose anyway, And Top Step's just a great, like, they've got a lot of resources. Like, they got a lot of good coaches and tools that you can learn how to genuinely trade better using them, in my opinion. But again, I'm biased. I always try to tell people, like, anybody promoting anything is going to be biased in that favor. And of course, like, people who aren't promoting them are going to, oh, they're, whatever. But of course, I'm biased. Everybody's biased. Anyways, green, slightly green, green, big time, red, green, red to green, green. So are you asking me if they give me basically like a... Yeah, I disagree. You break. And again, 90% of day traders lose, Again, if you're going to pay for a demo account, it's going to cost about the same. So I disagree. I think most people just lose and they get frustrated and they blame whomever they can. But it takes years to learn. Most people lose. And so you can either be stubborn, trying to look cool, and stubborn and fund your own account 20, 30 grand and give 90% of that up, most likely losing. Or you could try a funded account program. Still probably going to lose, but you'll probably lose less. And again, it's always up to you guys. One thing you learn in trading is everything's so subjective. Some people are going to find value in it. Other people aren't. Thus is life. But hey, I love you all. I appreciate all the views today. No, they fund the account, Bobby. But again, check with them, brother. Check with them. You can use the link in the description if you're interested. But yeah, check with them, bro. I'll see you guys later. Y'all be good. Have a great day. I appreciate all the love and support, guys. Genuinely, man. Today we got... How many views did we get today? We got over 30,000 people watching today's FOMC Minutes report with me today. So, hey, thank you so much. I appreciate the love. And, again, y'all have a great day. Hopefully, y'all made some money today. If not, tomorrow, we got jobless claims, unemployment filings tomorrow, bright and early. Chat, jobless claims, Yeah. I hope the Saints do good, brother. I really genuinely hope the Saints do good. LSU should do good next year, but go Tigers. Who dat? Let's hope we get a good team next year. I'm rooting for the Saints. Now I got to go tell Carol I got another freaking black eye at jiu-jitsu. Hey, I love y'all. Y'all have a great day. Even the haters, listen, let it out. It's okay. I love you too, Let it out. It's okay. You just need a place to let it out. So you can let it out here. It's all right, guys. Hey, have a great day. Later, chat. Salute to you guys. I'll see you guys later. Hey, thank you, Jonathan. I appreciate it, brother. Thank you, man. And just know, I'm not political at all, dude. I'm very neutral politically. In fact, the more people get wrapped up on either side of the political spectrum, the more I judge them. I'm very neutral. I hate all of that stuff. I dislike all bureaucrats. So, hey, y'all be good. All right, I'm going to get out of here for the third time. I'll see you guys later. Y'all be good.